You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing Royal Mail, Cranswick, Vodafone, Britvic, Futr, and Alibaba. So, John, should we kick off with Royal Mail?
Yeah, so Royal Mail, I'm sure it's familiar to everyone who lives in the UK. They announced their full year results for the 12 months ending March. Revenues were up to £12.6 billion, a 16.6% year-on-year rise, as the COVID pandemic led to big increases in the UK and international parcel volumes. Underlying operating profits were up 116% to £702 million, largely due to the increased volumes. And if we break those results down a little bit more, they said that the UK group's part of the business reported a 12% increase in revenues to £8.6 billion, with parcel revenue growth more than offsetting the decline in the letters business. Underlying profits in the division rose 194% to £344 million, and that was despite operating costs rising 9.2%. GLS, the European side of the business, saw revenues rise 27.8% to £4 billion, with operating profits up 72% to £358 million, despite a 24.7% increase in operating costs. Capital expenditure remained broadly flat at £346 million, but the group have said that this is expected to rise to £400 million in 2021-22 in the UK. Free cash flow for the year was up to £800 million or 22.5%, and the dividend has been suspended, and net debt in the last year fell 59.6% to £457 million, but the group have announced a one-off final dividend of 10p, with a plan to pay a progressive dividend going forward, with 20p per share scheduled for 21-22. The market cap of Royal Mail is approximately 5.2 billion, and it's got a price to earnings of only 10.6. That compares with an average of 12.7. Sam, do you have any thoughts on Royal Mail or these latest results?
I mean, the results were obviously excellent. There's no two ways about it. I think my main issue, really, it was, for me, the obvious comparison for Royal Mail was Deutsche Post, which we looked at a couple of weeks ago.
Yeah.
And when we looked at Deutsche Post, obviously they do the German postal service, but that was a much smaller proportion of their revenue, whereas with Royal Mail, so what did you say? 8.6 billion was the actual UK side and 4 billion international.
Yeah.
So you call the UK side 2/3. Of that 2/3, 59% of it now comes from parcels and 41% of it's post. And that's still quite a high percentage. And I appreciate the parcels is doing well. It's just the fact that I think Deutsche Post had a lower percentage that was coming from the actual, legacy post business. And Deutsche Post was trading at a slightly higher PE of about 15, but I think it was probably attractive enough that I'd rather pay 15 for Deutsche Post than Royal Mail at 10. That being said, I think Royal Mail looks like a good business at 10. It just doesn't look as good as Deutsche Post. What about you?
Yeah, no, I would say the same. And I think with Royal Mail, highly unionized, and it's still got that universal service obligation. And like you say, the percentage of letters, the legacy letters business, is still fairly high. So I suppose those reasons would make me a bit more apprehensive about it. But I mean, it sounds cheap, and people might want to take the risk on it because it, like, as sort of a value play, I suppose. But I mean, it's whether these sorts of profits can be sustainable, not sure. And it's, it is a competitive market. I think the overall figures for the UK parcel volumes in the last year, the figure was a 48% increase, I think, in the industry as a whole. So I suppose that rising tide has, helped it.
All both.
Yeah, exactly. Even your Royal Mails. But
I'd say I'm a bit more probably optimistic on Royal Mail as a business than you were on that. My main issue was it just wasn't as good as Deutsche Post.
Yeah. Well, just better options. Yeah.
But I didn't
But
get a
no,
PE of 10. I do think it looks reasonable.
it's yeah. Well, no, I was surprised at exactly how cheap it was. I think probably looking at it, if you looked at it last January, it would have looked less attractive as a business. But after the last year, it probably looks like it's in much better shape. One for your watch list, or
probably not. Whereas
Yeah.
Deutsche Post,
Yeah.
well, I'd say that was one for the watch list. Whereas
No,
Royal
fair
Mail, I think maybe. I guess if the legacy post business came down a bit more,
yeah,
maybe.
Yeah.
But even still,
yeah, that may
I
happen
get-
naturally.
yeah. And I just think as well with Deutsche Post, obviously DHL, it's a lot easier to judge how that brand is as an international brand because it's here and you just see it everywhere. Whereas with GLS for Royal Mail, I don't really have any familiarity with that. I've just got familiarity with the Royal Mail UK side of the business.
Yeah. No, I think that's fair enough. Okay, next company on the list.
So next up we have Cranswick. So for anyone who's not familiar with Cranswick, they are a leading and innovative, and this is from their website, by the way, a leading and innovative British supplier of premium fresh and added value products with annual revenue approaching 1.7 billion. Their core market is the UK, where they provide a range of high quality, predominantly fresh products, including fresh pork, convenience, gourmet products, and poultry. They have grown through targeted acquisitions and organic growth, and they now operate from 15 well-invested, highly efficient production facilities in the UK with a workforce of over 11,800 people. So, Cranswick have come out with their full year results, and so revenue has increased 12% to 1.898 billion. Net cash from operating activities has increased 55% to 181 million. Statutory profit before tax was up 10.4% to 114.8 million. Statutory earnings per share was up 10.9% to 176.4p. Return on capital employed was up from 16.2% to 17.2%, which they've said was helped by a full year contribution from the poultry facility. Net debt reduced by 37.1% to 92.4 million, which included the impact of IFRS 16. They've highlighted they've got a robust balance sheet with 200 million of bank facilities, providing over 170 million pounds of headroom. They've noted exceptionally robust demand across all product categories. They've highlighted the new 20 million pound premium cooked bacon facility is now fully operational, and they've committed to achieving net zero carbon emissions by 2040. In terms of the different categories, we've said fresh pork, which includes the 3 primary processing facilities and associated farming operations, represents 30% of group revenue. Like-for-like fresh pork increased by 0.1%, reflecting strong retail and export volumes, offset by lower wholesale volumes as more product was diverted into the group's internal supply chain. Despite the operational challenges caused by the pandemic, the average number of pigs processed each week during the year increased by 1.9% to 61,400, peaking at over 66,600 pigs per week in February in response to the continued elevated retail and export demand. We said the UK standard pig price ended the year at 141p per kilo, down 14% year on year. However, the average standard pig price for the full year was 1% higher than the previous year. The EU pig price for the year was 170p per kilo, but had fallen to 113p per kilo in early February as a result of the oversupply of pig meat in the region, driven principally by the continued ban of exports from Germany into China. Convenience, which comprises cooked meats and continental products and represents 38% of group revenues. Like-for-like sales increased by 14.1%, reflecting strong growth in cooked meats and continental products, including the contribution from Katsaurus Brothers. Convenience revenue was 18.5% higher than the prior year. Gourmet products, which comprises sausage, bacon, and pastry, represented 16% of group revenue. Gourmet products revenue increased 11.5%, with strong retail growth offsetting lower food service demand. Poultry, which includes fresh and cooked poultry, represented 16% of group revenue. Poultry revenue increased by 38.5% in the year, reflecting a full year contribution from the new iPoultry facility. The initial processing target of 1.1 million birds per week was achieved as anticipated at the start of the year, and production is now being lifted to the planned uplift of 1.4 million birds per week. There were a few interesting things in the slides. So they highlighted they've had 31 years of unbroken dividend growth. They highlighted record sales in retail channels with growth in all retailers and almost 70% growth for the top 4 retailers of Tesco, Sainsbury's, Morrisons and Asda. We said online shopping now accounts for 12.7% of total grocery sales versus 6.8% in 2020. Highlighted food service sales fell by over 50% in 2020. And in terms of the different sales channels, retail sales were up 25%, export was up 1%, wholesale was down 15%, and food service was down 49%. And finally, they also highlighted that the UK is only 62% self-sufficient in pig meat production. So that's probably good news for them as a UK supplier. In terms of the valuation, they trading at a market cap of 2.11 billion, PE ratio of 20.34, and a dividend yield of 1.75%. John, thoughts on Cranswick as a company in these results?
Well, it's a company I'd never come across before, but looking at their track record, it's incredible since 1990.
Yes, it's just very impressive.
Adjusted profit before tax. I think if you look back to 1990, it was 64 million, and then it's sort of grown exponentially.
Yeah,
and the dividends have followed suit as well, as you'd expect. But I mean, I don't know how it's managed to do that. And
they did post on the website, actually, they did post a little. They started in the 1970s as an animal feed business. 1980s moved into food production. 1992, deli cooked meats. 1995, gourmet sausage. 2001, continental fine foods. 2003, sandwich factory, which they got rid of in 2016. 2004, dry cured egg bacon. And this just goes on, basically just expanding the products. In 2013, they started rearing their own pigs. 2016, they integrated the chicken processing. 2019, new chicken processing facility. 2020, new pig rearing business, farming acquisitions. So they've basically expanded into all kinds of different meat products, and then they've gone back along the supply chain. So they're doing as much of it as they can themselves. So for example, 2021 is the first year they've had to cook bacon. 2022, breaded poultry. That'll be the first year for that. So yeah, that's how.
And going forward, what do they plan to do to sort of maintain that sort of growth?
Well, 2022, it just goes to breaded poultry. I don't know whether Brexit's possibly affected them positively. If there's more of a push towards UK produced meat, then that's obviously a good thing. If there were to be, for example, like more tariffs and stuff on EU meat, that would make it more expensive, which would make them more competitive. So I think there's possibly stuff like that that's going to help them out anyway. In terms of the rest of it, I don't know. There probably are other types of meats and products they're not in.
Yes, sure. And do you think there's any sort of move for people, sort of millennials, to eat less meat? Do you think that sort of longer term trend and the worry about global warming might impact on them at all? That
was my concern with it, because I don't know where the future of meat consumption's going and what time frame, but you'd think it's probably going down. In my view as well, my personal view, it's just, I think lab-grown meat just seems like a no-brainer solution if you can get the cost low enough, and that'd be a big problem for them. I know the technology.
Why do you say that? Why would you want lab-grown meat?
Because it would be exactly the same, but without the cruelty. That's you'd still get the same meat. So you've seen it where they've I saw a video on Facebook a few years ago where they grew literally like a burger or something, and they grew it in Singapore or somewhere like that, and the first one cost like $100,000, and this starts a couple of years old now, but they've managed to get it down to like $11 for a burger. Now that's still way too expensive, but as it comes down more and more, I think if you can have the meat without the cruelty, I don't know why you wouldn't.
Well, I'm sure Cranswick would say that they they treat their animals well. They don't. They're not. They've got high ethical standards.
I'm sure they would say that, but I guess if you're comparing, no matter how ethical it is, if you're comparing the killing of an animal to growing the meat without having to kill an animal, growing the meat's always going to be the more ethical one.
What about taste? I mean, I don't know what the comparisons would be like, but I mean, obviously corn, and I appreciate this isn't the same as the lab grown meat you're talking about, doesn't really compare to a lot of sort of actual aged steaks and things, does it?
It doesn't, but I do think that is something they should be looking at. And whether it's by an acquisition or something else, that is something I think they should be trying to offer. Because if that's the way the industry's going, or it's a larger proportion, it's going to be made up of the meatless products. I guess that's somewhere where that is an opportunity for them to grow, maybe, or at least hold their own. What did you think of the ethics of it? Would you consider it a sin stock?
No. No, I wouldn't. Absolutely not. And it's not like they've got lots of sort of, battery farm chickens or, I think looking at the ethical side of it, I think from what you see, and obviously you don't know what goes on, but it looks, fine from an ESG point of view to me.
See, I think I'd be fine having it in the portfolio at the right price. But I know if I tried to put it in my girlfriend's portfolio, there's no way it's going in there.
Well, it doesn't have to go in her portfolio, does it?
No, but it certainly wouldn't be.
No, I wouldn't have an issue with this at all. I think it looks like,
But I wouldn't say it's trading at any. What do you think of the price?
Yeah, I mean, I suppose if you look at the track record, you can see why, and the numbers that they have delivered, why it's trading at a premium.
Yeah, it's certainly not trading at a tobacco level discount, is it?
No, but equally, it's the performance, isn't it?
It is, yeah.
Historically, it's justified the price.
Over the last 5 years, the shares are up 73.98%.
Yeah, I mean, fair enough. It has continued to deliver. So
it's over 10 years, it looks like it's a four bagger.
Yeah, it's not what you'd expect from a meat processor.
No.
But I think it's certainly one that I'd look at in a bit more detail. But I think the numbers that it's delivered over the years. Wow, what a business. So
should we move on to Vodafone? Yeah.
So
not quite as impressive a business.
Not quite as impressive a business. And so Vodafone, they had their full year results out, and the group announced that they had a 2.6% fall in revenue to 43.8 billion euros, and they attributed the decline to, in part, the disposal of Vodafone New Zealand's lower handset sales and lower roaming revenues. And then this was somewhat offset by the acquisition of Liberty Global, which is a TV and broadband company which operates in 6 European countries. And the EBITDA for the group was down 1.2% to 14.4 billion euros. If we break those results down a bit more, so Vodafone says that organic service revenue, or OSR, overall for the company fell 0.1% to 37.1 billion euros. In Germany, OSR rose slightly to 11.5 billion euros, or by 0.5%. Total revenue in Germany up 7.5%. And that was, they say, largely down to the Liberty Global acquisition. Underlying cash profits in Germany were up 1.8% to 5.6 billion euros. In Italy, OSR fell 7.5% to 4.5 billion euros, and total revenues there were down 9.3% to 5 billion euros, and underlying cash profits were down 12.7% in Italy to 1.6 billion euros. In the UK, OSR fell 0.8% to 4.8 billion euros, with total revenue being down 5.1% to 6.2 billion. Underlying cash profits fell 7.3% to 1.4 billion euros. Spain saw OSR fall 2.8% to 3.8 billion euros. But interestingly, underlying profits, cash profits in Spain were up 3.4% to 1 billion euros. And they put that down to lower football content and commercial costs. Other Europe, which includes Portugal, Czech Republic, Hungary, Ireland, Greece, and Romania, saw OSR fall 1.4% to 4.9 billion euros, with underlying cash profits falling 0.5% to 1.8 billion euros. And for most of the European market, Vodafone was hit by increased competition and the loss in roaming revenues with COVID. South Africa, OSR under Vodacom grew 3.9% to 4.1 billion euros, and underlying cash profits in South Africa were up 2.9% to 1.9 billion euros. Other markets saw OSR increase 10.8% to 3.3 billion euros, and underlying cash profits rose 8.5% to 1.2 billion euros. Free cash flow before spectrum restructuring and integration costs fell 5 billion euros, or by 11.9%. And capital expenditure rose from 7.4 billion euros to 7.9 billion euros, with net debt falling 3.6% to 40.5 billion euros. And at present, Vodafone has a market cap of about 35.6 billion as the end of trading on Friday, and price to earnings of 16.4, with a prospective dividend yield of about 5.5%. On the news of these results, the shares were down 7.6%, and so they're not well received by the market. What do you make of those results and Vodafone as a company, Sam?
I thought they were poor results. I don't really buy the reasons that management have given for the decline. You know, when they explain the reasoning for it, I don't sort of think, oh yeah, that makes sense. It's just, I think the business has just performed poorly, and it's performed poorly in a pandemic. So they're trying to like link it, but really, I think it's just done a poor job. And I think that's particularly demonstrated by Italy, where their total revenue dropped 9.3%. That was like primarily due to price competition. And I think that's the problem it's got. Because most of the business is based in Europe, it's effectively being commoditized. I know the dividend yield's attractive, but I think at a forward PE of 16.4 for a declining business, I think it's not as cheap as I'd possibly expect it to be.
No, and it's been performing poorly over the last, at least the last 5 years. I mean, the share prices, reflects that. It's down 43.4% over the last 5 years. And like you say, it's incredibly price sensitive, and you've got high capital expenditure costs. It's got a lot of debt. I'm not entirely sure about the sort of the Liberty Global acquisition. They say that it will reduce. It'll generate sort of capital expenditure savings.
They always say
that. From Vodafone's point, what they've said is of about 500 million euros a year. But no, I do really, struggle with it. If you were to say what's on the positive side of it, I suppose there might be big upsides to 5G, and that the roaming revenue you'd expect to return if we go back to traveling. But there's little positive that I see in the business. It's got a lot of debt, and you wonder going forward, will they be able to maintain the dividend as well? That's one of the attractive things about, or one of the few attractive things about it at the moment.
I thought the debt was actually, it's not great, but it was, I think it was about 2.5 to 3 times profits, which I thought it was manageable as long as those revenues and profits stay where they are. The problem is, it looks like it's somewhat of a declining business.
Yeah.
And that would be the problem, that the business shrinks to a level where the debt is a serious issue. So at the minute, it's manageable, but it's certainly not at a level where you'd look at it and say, oh, well, that's completely fine. It's more, they can still afford to pay it comfortably.
Yeah. In comparison with BT, I know that they're not the same company at all, or similar in many ways, but I'd choose Vodafone over BT, but I don't really like either, to be honest.
There's very few businesses that I wouldn't choose over BT.
That's true.
Well, how do you think it compared to Airtel Africa?
I'd be much more interested in Airtel Africa, quite honestly.
Right, shall we move on to... It's Britvic next.
It's Britvic. This is a company I like more, but do you want to tell us about the results?
Yeah, so Britvic, I'll just, from anyone who's not familiar with Britvic, I'll just read this from, it's actually from their results. It's just about the About Britvic section, which I think describes them quite well. Britvic is one of the leading branded soft drink businesses in Europe. The company combines its own leading brand portfolio, including Robinson's, Tango, J2O, London Essence, Miwadi, with PepsiCo brands such as Pepsi, 7-Up, and Lipton Iced Tea, which Britvic produces and sells in the UK and Ireland under exclusive PepsiCo agreements. Just as an add-on, they've recently, or within the last year or so, they've extended that. So I think they've got the license for another 20 years or something like that. Britvic is the largest supplier of branded still soft drinks in Great Britain and the number 2 supplier of branded carbonated soft drinks in Great Britain. Britvic is an industry leader in the island of Ireland with brands such as Miwadi and Ballygowan, in France with brands such as Tissier, Pressard, and Moulin de Valdon, and in Brazil with Maguari, Bella Ichia, and De Fruta. Britvic is growing its reach into other territories through franchising, export, and licensing. So you've come out with their half-year results, and revenue was down 11.7% using actual exchange rates to 617.1 million. If you were to use constant exchange rates, the decrease is only 6.3%. Earnings before interest and tax was down 16.7% to 52.3 million. Profit after tax was down 14.7% to 33.2 million. Earnings per share was down 15.6% to 12.4p, and adjusted earnings per share was down 20% to 15.2p. And the adjusted net debt to earnings before interest, tax, depreciation, and amortization now stands at 2.8 times. They've highlighted strong growth in at-home channels, resulting in continued share gains in Great Britain and Ireland. Which said Britvic GB at-home channel retail sales volume up 6.2% versus 1.6% for the soft drinks market. And that's led by family favourites Robinson's, Pepsi Max, 7-Up, and grocery online outpacing strong market growth. Which said they're into the 4th consecutive year of revenue growth in Brazil. Pandemic restrictions have heavily impacted performance in hospitality sector and on-the-go consumption. Significant progress against their strategic objectives, including relaunch of Rockstar in second half to accelerate growth in the energy category. You may be familiar with Rockstar because they recently acquired the license for it from AG Bar, which we covered a couple of months ago now. They highlighted the acquisition of Plenish, a premium plant-based beverages brand in a fast-growing category. And in terms of the revenue per sector, so bear in mind this is out of total revenue of 617 million. GB, which is the majority, had revenue of 413 million, and that was down 4.8%. Brazil, revenue of 56 million, and that was actually down, despite them saying it was up. So the reason it was down is it's up in whatever the Brazilian currency is, but when you take exchange rates into account, it's actually down 15%, but that's not really their fault. And rest of the world, but it's still a bit naughty saying it's up, isn't it? And then highlighting 4 consecutive years of revenue growth. But anyway, revenue for rest of the world is 147.9 million, and that was down 25.6%. So there are a couple of interesting points in the slides as well. Yeah, so they've highlighted, I think I mentioned this already, but their at-home sales are up 6.2%, and that compared to just 1.6% for the market. They've highlighted that Pepsi Max in GB was actually the number 1 cola variant by volume in at-home, which surprised me. I'd have expected it to be Coke. And they've highlighted that 7-Up was the number 1 lemon/lime brand by value and volume in at-home. In each of their markets for flavoured water, they have the number 1 brand in the category. And they also highlighted the relaunch of Rockstar, and they said they pointed out that historically the brand's underperformed the category. So they've relaunched it with a new premium brand identity, improved, better tasting liquids, And they obviously think they can do a better job with it than AG Bar did. So, in terms of the valuation, they're at a PE of about 24 if you use the adjusted PE. And if you normalize that adjusted PE, you get to about a PE of 16. My view was these aren't great results, but it's to be expected. And I continue to like the business. I think really you can't judge them until things are back to normal. And a revenue drop of 6%, the fact that they are still profitable, just not as profitable as before, they are doing fine. What are your thoughts, John?
Yeah, I'd probably echo that. It's really, I suppose it would really be a case of seeing where we get to over the next year, 2 years, and whether they're able to, I suppose, how much they're able to grow. And they've got, what's the dividend at the moment?
2.27%.
2.27%, and I suppose growing the dividend as well. Whether Rockstar, how well they can do with Rockstar as well, that'll be interesting to see. But yeah, no, it's not. I mean, not fantastic results, but a quality business with quality brands. Yeah, I've got a few similar sort of consumer goods companies, so I probably wouldn't be looking at it right now, but it's on my radar.
Yeah, I mean, I think this is the first time, we've covered it a couple of times already, but I think last time I didn't really appreciate that maybe about 1/3 of their revenue actually comes from overseas. I thought they were more UK focused.
It's actually a bit more diversified.
It is, it's more diversified than and the rest of the non-UK revenue, that's pretty much all going to be brands that they own as well. Whereas with GB, they obviously have some dependency on the Pepsi brands, which is fine because they've got another 20 years of the license. But I guess there is that opportunity that if they can grow the non-GB side of the business, because I think GB is probably pretty saturated, to be honest. Like maybe a few people will switch from Coke to Pepsi, but you're not going to get that much movement. Whereas I think with the rest of the world and Brazil and places like that, I think they do have the chance to actually grow the business, which I think it's a good business and I like it.
Yeah. Well, moving on to our last UK company, we've got Futr, which is a media company, probably best known for its magazines, Country Life, Marie Claire, Tech Radar, and recently it's gone into price comparison with the acquisition of GoCompare. Anyway, they've had their half-year results out, which saw revenues rise 89% to £272.6 million and underlying profit grow 89.2 million compared with 39.9 million last year. We have to break those down a bit more. And if we look at the media division, which accounts for about 2/3 of the group's revenue, that saw its revenue rise about 30% to 182.6 million, with digital advertising growth up 26% and e-commerce revenues up 56%. These were partially offset by declines in the events business, which comes as no surprise with the pandemic, were badly hit. The UK media side of the business was up over 100% to £75.3 million, and the US media business was up 34.8% to £107 million. In terms of the magazine business, that saw revenues fall 15% with the pandemic, and the UK saw organic revenues rise 5%, and the US 31% rise in organic revenue. And that's reflective of the UK being more exposed to the event and magazine revenues, which were obviously badly hit by COVID. Underlying adjusted operating profit, excluding the fees and restructuring costs relating to the GoCo acquisition, rose to £19.3 million from 1.6 million in the UK, and the US saw adjusted profits increase 82.5% to £69.9 million. Underlying operating margins rose 33% with multiple revenue streams and increased scale. The GoCo deal was completed in February at £557.2 million, 75% of which was paid for or by the issuing of new shares. And Futr said that they expect this deal to generate £15 million of cost savings each year. Underlying free cash flow stood at 93.9 million, and net debt increased from 62.1 million pre-GoCo acquisition in September to 241.3 million pounds after the deal. Price to earnings stands at 22.2 compared with a 10-year average of 9. And it's currently got a market cap of 3.36 billion pounds. What do you make of these half-year results, Sam, and in particular the acquisition of GoCo?
I thought these results were very, very good, but I just think so much of it comes from the magazines, and I just think, like, how many people are sat at home for the past year with nothing to do, subscribe to a few magazines, and how many of those people are actually going to stick with them? I don't see that growth continuing. If anything, I'd probably expect the revenue to drop from the magazine side when people start cancelling their subscriptions. And a forward P of 22 compared to a 10-year average of 9, there's quite a bit of growth baked in there.
If you argue that the magazine industry is a declining business and people looking to social media for their hobbies rather than getting a magazine subscription, I mean, that may have been, well, probably was one of the reasons that they were looking to diversify with the acquisition of GoCo.
Yeah, and I just think as well, like, they can try and switch, whilst it's like higher margin for them online, I think the actual opportunity for them online to switch subscriptions from print to online, I think it's fairly limited, because I think if you look at the kind of magazines that someone would pay an online subscription for me, it's really, really well known. It's New York Times, it's Washington Post, it's those kinds of businesses. And I don't think, looking at their list of brands, they really have any of those. And I think it's a big problem for them. And that being said, I think the business is more attractive with GoCo in it. They did actually say in the results as well that if the acquisition had been completed on the first day of the financial year, GoCo would have contributed £85 million of revenue and a profit before tax of 18.2 million. So I guess it would have made up about a third of the, well, I guess it wouldn't, because the revenue would have been higher, but that's about a third of the current revenue for the full business. And what is it, less than a quarter of the profit before. So it's not going to make a huge difference, really, is it? It's still only, maybe 30% of the business.
Yeah.
And I do wonder as well, it's easy to say, well, this is a good business. If the magazine side's going to decline, we'll just take this. But are they going to be able to manage it properly when it's not their primary focus?
Yeah, these are the things that I struggle with. And yeah, while the results were really positive, I think there are a lot of unknowns, like you've highlighted.
I don't like it, as you can tell.
Yeah, I don't think I'd know enough, and I think there are too many question marks at the moment. I'd be interested to see how it does, and maybe look at it a little bit more. But there are lots of question marks for me.
Yeah, I mean, the only reason I like looking at it is because I own Money Supermarket, and I like to get that comparison with GoCo. Otherwise, this isn't a business I'd want to look at all, probably. And I think if I was to buy Future, I'd probably be buying it for GoCo rather than the magazine business. And if you want that, why wouldn't you just go with the market leader in Money Supermarket?
Yeah, I mean, it's had phenomenal share price growth over the last 5 years, but it's been a 23 bagger.
All right. Well, what do I know then?
it's. I mean, it's not to say that's what it's going to be like going forward, but yeah,
it's very impressive. That.
Yeah.
Would you ever consider it?
With my level of knowledge of it at the moment, no. And I certainly would be very concerned about the sort of, well, you can't really call it the legacy part of the business, but of the magazine, the magazine sector. And I don't know enough. You see, I always imagine price comparison. I know you've got Money Supermarket being, a very competitive market in itself, and lots of people with their sort of fingers in that game. But yeah, do you think it made sense for made sense for Future to acquire GoCo?
It depends. It depends, doesn't it? 'Cause I can see the logic if you buy this business and, maybe as like the magazine business declines, this grows. But I guess they could have also taken the view that if the magazine business is going to decline, we can just try and get as much cash out for the shareholders. And if they want to buy a price comparison website, they can go out and buy GoCo because it was listed prior to this. But, we're talking about it as if it's guaranteed to decline, but revenue for the half was up 89% year over year.
Yeah,
so they might not be looking at it that same way.
Yeah,
they might think they can continue to grow it.
Yeah. Interesting. Well, again, one to watch.
Not for me.
You're not interested in seeing whether it does 23 bagger again.
I thought you meant like one for the watch list.
Okay. Yeah, fair enough. Right. So shall we go to our US listed company?
Yes, we have Alibaba this week. So
okay. So do you want to give a bit of it's pretty well known, but do you want to give a bit of background on Alibaba, Sam?
It's basically the Amazon of China. I don't think I really need to describe it any more than that. You should be able to. If you don't know what Amazon is, I'm going to have to just tell you to Google it. Yeah, okay. So Amazon of China, they've come out with their Q4 and full year results. Daniel Zhang, chairman and CEO, said in his comments, Alibaba achieved a historic milestone of 1 billion annual active customers globally in the fiscal year ended March 2021. Maggie Wu, CFO, said, we surpassed our annual revenue guidance in fiscal year 2021 by achieving strong organic revenue growth of 32%, excluding the consolidation of the newly acquired Sun Art. This was driven by robust performance in our core commerce business, as well as continued growth of Alibaba Cloud. Our adjusted EBITDA grew 25% year over year, while we increased investments in new businesses and key strategic growth areas. So business highlights for the quarter ending 31 March 2020 was revenue of 28.6 billion, and these figures are in dollars, which was an increase of 64% year over year. However, excluding the consolidation of Sun Art, the revenue was only up 40% year over year. Annual active customers on the China retail marketplace was 811 million for the 12 months ended 31 March, an increase of 32 million from the 12 months ended 31 December. Mobile monthly active users on the China retail marketplace reached 925 million in March 2021, an increase of 23 million over December 2020. Loss from operations from the quarter was 1.17 billion, and this was primarily due to a 2.78 billion fine that they were given by the China State Administration for Market Regulation in relation to it was basically an anti-monopoly fine, which was one-off, and it's probably more a slap on the wrist for the comments made by the former CEO about the Chinese Communist Party. So I wouldn't expect that to be repeated. And they've said, however, if you look at adjusted EBITDA, that increased 18% year over year to $4.5 billion. For the full year ended 31 March 2021, whereas before it was just for the quarter, revenue was 109.48 billion, which was an increase of 41% year over year, and excluding the consolidation of Sun Art, which started in October 2020, the revenue would have grown 32% year over year. Annual active customers for the Alibaba ecosystem reached a milestone of over 1 billion, including 891 customers across the China retail marketplace, local consumer services and digital media and entertainment platforms, and approximately 240 million consumers outside China. Annual active consumers on the China retail marketplace was 811 million, an increase of 85 million from the 12 months ended 31 March 2020. Gross merchandise volume, so that's the total amount of the transactions in the Alibaba ecosystem, was 1.2 trillion, which mainly included the China retail marketplace's gross merchandise volume of 1.14 trillion. Income from operations for the full year was 13.6 billion, which was a decrease of 2% year over year, primarily due to the above mentioned anti-monopoly fine, and adjusted EBITDA increased 24% year over year. We've said the net income attributable to ordinary shareholders for the year was 22.9 billion, an increase of 30% year over year. And interestingly, the cloud computing side of the business grew 37% and now makes up 9% of revenue. However, So that would be with revenue, I think, of 25 billion now. However, it's actually loss making at the minute, which is quite interesting because in Amazon, most of the profits come from the cloud computing, and then the retail side of the business, the actual marketplace, is very, very low margin. Whereas with Alibaba, the retail side of the business is quite high margin, and that's being used to grow the cloud computing, which is loss making. So it's a bit of an inverse there. Interestingly, Charlie Munger recently bought this for the Daily Journal, which is one of the companies that he is chairman of. And Manish Prabhai also bought it in his fund recently, and it's his largest position. In terms of the valuation, the business is trading at a PE ratio of almost 25. However, the market cap's 581 billion, and that includes about, what is it? I don't know, it's about 70 billion of cash. I've not written down the exact figure, but if you take out the cash and work out the PE based on that, it's actually a PE of 21.7. And that's for a business that's growing organically over 30% year over year. John, thoughts on Alibaba and these results?
Really impressive results, and it's not the valuation that you'd expect from a tech stock. I guess it's potentially down to sort of the politics of it all, which maybe is why it's sort of discounted in comparison with, you know, the obvious US competitor, which is Amazon. I've got a world ETF, and Alibaba, I think, is about 1% of that. So I do have, I definitely do have some exposure to it, but I wouldn't be averse to actually buying shares directly in the business.
I agree. I think that is unbelievably cheap. I mean, when we talk about the US listed company week after week, for a company putting out this kind of growth, it wouldn't be surprised. We'd say it was expensive, but it wouldn't be surprising to see it at a price to sales of 25 rather than a PE. I appreciate that's partly because the market cap's already so big, but I think that is very, very cheap. And I think the reason is because of the Chinese Communist Party. I think that's the main concern, especially with, do you know the founder, Jack Ma? You know, he disappeared for like 3 months.
Vaguely, yeah.
So basically, he did a speech or something, and he made some kind of comment about that. I can't remember what it was now, but he made some kind of comment about the Chinese Communist Party, and then he just disappeared for like 3 months, and then he reappeared to basically do a video saying how much he loves the Chinese Communist Party. And Alibaba has then been investigated for like anti-monopoly stuff on the back of that and been slapped with that fine. He's no longer at the helm anymore. So I don't view that risk as highly as if he was. And I don't think it would be in China's interest to really go after Alibaba that much, to be honest. I kind of view the fine a bit similar to when the EU slapped fines on Google. You know, they can pay it, and it's a one-off. Maybe at some point they'll slap another fine on them and they'll be able to pay it comfortably. But it's not something I really worry about. And I think that's more than baked in at a PE of 25.
Yeah.
Of the 6 companies we've talked about this week, Royal Mail, Cranswick, Vodafone, Britvic, Futr, and Alibaba. If you had to buy one, which one would you be going for?
I'd probably go for Alibaba, I think.
Really?
Yeah.
I thought you'd been, you sounded like you'd been taken with Cranswick. I thought you'd be going for that.
Yeah, I don't know.
I think Cranswick, Britvic, and Alibaba are all good businesses. They're probably the ones that, for me, I'd be choosing from.
Yeah.
But I'd go with Alibaba as well.
Yeah. I suppose it's what I'd be thinking about would be just the longer term, and I don't know enough about the sort of meat processing industry and whether you know, as we mentioned, whether it is going to be in the longer term an industry in decline, even if Cranswick is a very good company at the moment.
Okay, so that's the end of the stock segment. This won't be a regular segment, but I do think we just want to have a little chat about the froth that we've seen in the cryptocurrency markets recently.
Okay,
so John, do you want to take us off with your experiences down on the ground?
Well, I know some colleagues I work with, they weren't happy this week, and you saw lots of phone screens and people trading on the margin. with multiple different cryptocurrencies, biggest of which being Bitcoin, and having portfolio sizes cut by sort of maybe even up to 50%. And obviously if that's leveraged, it can be even higher. And, some people sort of losing, or at least on paper, tens of thousands of pounds, being thoroughly miserable. But I suppose it does show how many people, sort of, I guess, retail investors have been experimenting, trading, arguably investing in different crypto assets. We saw the price of Bitcoin crash. There were some comments by Elon Musk, and there were sort of various events in China that could be attributed to the sell-off. But what do you think? What did you make of it all, Sam?
Yeah, I mean, I've got a similar experience to you. Like, for example, it's about a week ago, might be a week ago today, actually. But I got a phone call from someone I work with, and I was actually busy, so I didn't answer it. So then they messaged me. They said, Sam, this is not a joke. I need you to tell me where I can buy Dogecoin right now. So I told them, and I said, look, I don't think you should do this. Well, because it's already run up. However, whatever the figure is, it's a ridiculous amount, isn't it? Over a year, it's up like hundreds of thousands of percent. So I did say that, but I said, you're a big boy, so you can go do it. And it's literally, I don't think it's been that high since he bought it. And it's very, very difficult, because I think when he bought it, it was about 30% down from the top, and he thought he was going to go and hit $1. And the problem is, like, if something like this drops, say it drops 50%, it can still drop another 50%, especially when it's that volatile. And when you're not that used to it, it's very, very easy to get, burned quite badly by it. And that's even worse if you're trading on margin. Especially with, I don't really want to talk about like the whys and whats we think of like the markets in general that much. It's more just the observation that there's a lot of people buying this stuff who don't know anything about it. And there's, like, for example, we went out for dinner a few weeks ago with one of my girlfriend's friends and her boyfriend. And this guy that weekend had started buying some cryptocurrencies, and he just listed off these names, and they just sounded like absolute rubbish. Like, and like one of them, like one of them was called like Safe Moon. And he's like, I explained to him why I thought it was like a pile of rubbish. And he basically he was like, yeah, but this thing, like, I bought this one on Friday and I got 3x. How do you, the people don't.
Yeah, do you think that's an investment case then?
Well, the problem is you hold it and then you start trading. You never, like, a lot of people don't get the money out, do they? They put it in and then on paper they make a multiple of it, and then it crashes, and it ends up, like, it happened to me in 2017. I put some money in and it probably about 10x in 4 months, and then I just rode it all the way down. I was quite fortunate in that I added early enough on that I don't think I was ever really actually down on my initial investment, but I was adding on the way down thinking I was buying the dip. And then some of these things dropped 90, 95%. I mean, some of them dropped even more than that. I had one that was down, it must be 98 or 99%. And they can do that, especially when they've run up so high. And I think a lot of, I think just don't get sucked into it really. And I think if you're gonna, I guess it's just not, it's not really investing, is it? Because you don't, like, if someone could sit there and explain to me where the value from SafeMoon comes from and why they think that in 10 years time, SafeMoon's going to be something that they want to be holding, and, and they don't mind if it drops 80% in the meantime, because in 10 years time, everyone's going to be using SafeMoon for this and that, and this is how the token's going to be valuable, then fair enough. But I don't think they can do that. And for me, I think the only cryptocurrency really where I can actually do that and make that argument is Bitcoin. And that seems to be the one cryptocurrency that people aren't actually buying. I know it's run up a lot, but like that guy that we went out to dinner with, he bought all the other ones. He hadn't bought any Bitcoin. Same with the guy at work. He was buying Doge. He wasn't even buying what I think is the one that's actually going to stick around.
Yeah, no, I appreciate it. do you still stick by having an allocation of the portfolio portfolio to Bitcoin?
Well, yeah. I think just averaging is the key, isn't it? I mean, if you bought a bit at the top, but you were averaging, it doesn't really matter. And if you're averaging in again now, then that's quite good. But I do think in 10 years' time, I think Bitcoin is going to be a higher market cap than it is today. But I thought that at 64,000, and I thought it a year ago at 6,000. I don't feel the same about Dogecoin and SafeMoon and all these others. That doesn't mean they're all going to go to zero, and some of them probably will stick around. But knowing which ones is
very difficult.
Very, very difficult game to play. And definitely don't buy it on margin.
Yeah. Do you want to end it, Sam?
On that somber note, stay safe, kids. Thanks for listening.
Okay.
We'll see you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.